Good afternoon. Welcome to the weekly livestock market update. I'm Brownfield anchor reporter Megan Grevner. With us as always to talk all things markets, University of Missouri, Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
A busy week this week. Next week's kind of the calm before the storm, and then we get really wild and crazy the week of Christmas before we wrap up in the end of the year. And I can't believe, as we're talking, we just have 3 more Fridays before we head into 2023.
It seems like we just got the January 2022 weekly livestock update yesterday.
I would like to agree. I would have to concur with you, sir. All right, today we're going to talk some consumer sentiment. We're going to talk trade, demand, and we're going to talk quite a bit at the end about managing risk, which is something you're going to hear a lot from probably both of us over the next few months and well into the start of 2023. But to get things started, let's recap and talk about what happened this week in the markets.
Yeah, on the cattle side this week, Megan, slaughter-ready cattle were down nearly 50 cents. Feeder cattle markets were stronger this week. I'm going to call them steady to $4 higher. On the future side, February live cattle futures contract was down 25 cents, and the January feeder contract was up $1.45. On the beef side, choice box beef prices were down $7.50. That puts them nearly $21 below where they were a year ago at this time. On the hog side, cash barrows and gilts this week were down 70 cents. We lost a lot on the February lean hog futures contract this week, down $6.40. We lost 25 cents on the pork cutout value as bellies were down nearly $6 this week.
It definitely has been a different conversation on the hog side of things as we've moved through, I'm going to say, the last couple of months, really, especially as we take a look at those cash prices.
Yeah, for sure. And I think you look back, and although we've moved down in those hog prices, they're still high relative to maybe what we might think of longer term. Not that I want to say we're in the right place now, but it just reminds you there's downside risk in that market as well.
Weekly slaughter numbers as we take a look at this week, kind of interesting looking on the cattle side of things. It's been a long time since we've had a full week where we've seen less slaughter.
Yeah, that's right. For the week ending December 10th, USDA is telling us a run of 652,000 head of cattle to be slaughtered. That's down 11,000 head from last week, but also down 15,600 head from where we were a year ago. On the hog side, a run this week of 2.572 million head of hogs. That's down 18,000 from last week and down 4,400 head from where we were a year ago.
Talk to me a little bit about the year-to-date slaughter percentages. How are they changing for both the cattle and the hog side of things?
Yeah, so we see on cattle slaughter, we're now 1.4% year-to-date above a year ago levels. I like to at least stop for a minute and say it's amazing what drought in terms of beef cow slaughter, and then heifer slaughter as well has done to increase total year-to-date slaughter. But on the hog side, down 2.6% year-to-date.
We're going to start first, kind of shuffling things around this week, talk a little consumer sentiment before we get into some of the demand and the trade side of things. As we look at the consumer sentiment for December, a little bit of an uptick, and I don't want to say maybe like we're shifting momentum, but it's sure nice to have a positive number to talk about.
Yeah, that's true, Megan. An index of 59.1 for December. That's 4% above where we were in November, and we actually then got back most of the losses. So if you remember when we talked November was down pretty hard. So we got back a lot of the losses that we saw in the November numbers. When you look at kind of the combo here, current situation or current economic conditions, portion of that index was 2.4% higher. The expectations component was 5% higher relative to last month. So moves in the right direction. I would say, I think less worries about high prices, inflation generally, I think were helpful to what we saw in the December report. However, I think it's important to remind ourselves that the December 59.1 index is still 16% below where we were a year ago.
It feels like there's been a little bit of calm or a little bit of maybe a less craziness in terms of the economy just in the last couple of weeks. I don't know if that's helping, and I certainly don't expect it to completely right the ship, but it's, again, sure nice to have a little bit more normalcy to talk about.
Yeah, I sure hope you didn't jinx us with that comment about less volatility, but you're correct. I think as gasoline prices have been moving lower than many maybe would have thought was going to be the case, we're getting signs inflation, at least as the rate of growth is beginning to slow, maybe not as fast as some would anticipated. So to me, that seems to be giving us a little bit of positive spin here. We're still too early to get, I guess, overly excited about 2023. I think most of the general economy forecasters would still suggest that we're going to talk about perhaps a downturn in real GDP for 2023. So, but yes, maybe a little less of the big volatility we've been seeing of late.
All right, let's talk monthly trade data. Another fairly solid month for beef. And pork gets to have its own little bright spot for the first time when we're talking year-over-year numbers.
Yeah, that's right. So when you look at beef exports first for October of this year, about 301 million pounds of beef exports. That's 9.7% above where we were a year ago. China continues to be important to this mix. They were up nearly 13%. South Korea this month was also another positive note here, up 17.5% relative to year ago levels. When you look at year to date, nearly 3 billion pounds of beef exports year to date, 5.1% above where we were a year ago. And just a little perspective, China, Hong Kong, Taiwan, all three together, they're just up 118.5% from where we were in 2019. So some pretty amazing numbers setting there. Again, I'll say, don't forget, it was a small number back in 2019, so the percentages probably overstate things. On the pork side, 540 million pounds of pork exports October of 2022. That was actually up 0.1% relative to a year ago. So it's nice to be on the plus side there. I'll say some increase in China was helpful. Also South Korea. In terms of relative to year ago levels. Yet when you look at overall pork exports, 5.2 billion pounds year to date, that's down 12% relative to where we were last year. And the tidbit here I'll say is when you look at Mexico, we talk a lot about Mexico, and we talk a lot about the ham prices as a result. Mexican pork imports from us up 48.8% relative to where they were in 2019 year to date.
I'm gonna two questions. One, it's been a long time since we talked about China pork imports or exports to China being up. What cause do we know what caused that uptick for October?
So I think it's still tough to get, to know for certain what's happening. I think we could talk about some of the same things that we maybe talked about in the past of maybe a little less COVID lockdown going on there, and that might continue to happen as we move forward, maybe being a big part of that. I'll also say, we had pretty low trade back in October of 21. And so although we're up in 22, it might be much a function of the lack of strong exports in 21 leading to the rebound here. So I don't want to be overly optimistic. I will keep saying I think we can get a little bit of positives maybe in terms of exports to China in 23 to still happen, Megan.
My other question is, there's been all of these conversations talking about Mexico's ban on GMO corn products and the conversation about feed, all of those things. My question is this a slippery slope? Do we need to be concerned about our products? We know how much pork gets exported into Mexico, knowing what we feed in the US, and how does that potentially does that have to be something that's at least on the radar to think about moving forward, knowing that this is coming on the corn side of things?
Yeah, so I think you're wise to say it needs to be on the radar. I'm not sure yet that I'm overly concerned, but if we see follow through of no GMO corn into Mexico, certainly could be troubling for hams as well, just given how we know we feed those hams today.
All right, supply and demand numbers out today. As we take a look at those, really not kind of a lackluster report in terms of the livestock side of things.
Yeah, I sometimes joke USDA is really good at forecasting 2022 now that we're in December. So not a lot of change. We can kind of look ahead here to 23. I will say generally the big change is we continue to see growth in chicken production. USDA's raised 2022 another 120 million pounds and raised 2023 by nearly 100 million pounds. Those are really the big changes, which in the grand scheme of things, when we're producing 46 billion pounds of chicken annually, 100 million pounds is not a whole lot. Not a lot of price changes, pulling down turkey prices a little bit in this in the December report for this year. Feed costs also not really changed much. Reduced corn prices for 22-23 crop by 10 cents, increased soybean meal prices by $10 a ton. So not any really big changes we saw today.
As we wrap up today, we're going to start a conversation, and I don't know if we're going to talk about it every week, if we're going to talk about it every other week, if we're going to talk about it monthly. We may talk about it twice in one day. I'm not sure. Risk management is something that we really have to think about. We talk so much about the potential rise in prices, especially on the beef side of things going into 2023. I've had a lot of questions about the livestock risk protection program, and is it worth it for small producers? And I think that's something that probably we need to talk about in terms of what producers of all different sizes need to know about LRP and this program that you and I talk about on a fairly regular basis.
Yeah, so I will say there's a lot of positives here when we can have this LRP discussion. And I'm going to start kind of at the 30,000 foot view for a minute. Number one, for small producers, you can insure one head. So it is for small producers. If I wanted to go get a put option straight off the CME, I got to purchase the entire put option. So I might be over-insured, if you will. Here with LRP, it is meant for smaller producers as well. Now, I can have a maximum of 12,000 head of feeder cattle in a single endorsement under LRP, but 1 to 12,000 gives producers of a lot of different sizes the opportunity to participate. In terms of subsidies, I think it's important to remind ourselves that LRP's changed the level of subsidies. They've increased them. If I'm willing to only want coverage between 70 and 80% of the current value of that contract, I get a premium subsidy of 55%. Now, if I want to be much closer to in the money, that premium subsidy goes down to 35%. But those are much larger numbers than we would have talked about a few years ago. So it might make more sense than it did in the past. Just to talk about kind of opportunities here. So I pulled yesterday for Missouri weight one steers, and I'll say, when I say weight one steers, that all matters. And I don't think producers have to know all those ins and outs, but they need to find an agent that can help them with all those ins and outs. Weight one steers are between 1 and 600 pounds, I believe, or 100 and 600 pounds. Sorry, I believe. But if I go 47 weeks out and I get as far out of what I'll say out of the money as I can purchase a contract on my animals for $2.38 a hundred. That was Thursday. We're talking Friday. That's relatively inexpensive. You think about how many hundredweights you're going to try to cover there whenever you sell those feeder cattle, but relatively inexpensive. Now, if I want to be near the money, those increase to like $7.82. Still might make sense for someone. I talk about out of the money, just trying to reduce the cost. I think producers need to think through that for themselves in terms of how much risk they want. I will just keep saying, and I've said this several times recently, I hope producers pay the premium with an LRP contract and never get an indemnity. Under that scenario, prices go higher. They are better off, but this creates the floor that keeps them from losing more money if cattle prices go much lower in 2023.
I feel like it's a conversation about covering your assets.
Correct. This is not maximizing the price you're going to receive. It is all about, for me, protecting downside risk as cheaply as I can to make sure my operation stays in business over the long term. And what am I willing to pay? What kind of insurance premium am I willing to pay to put a floor on the prices? You don't pay this trying to maximize the price you're going to receive. And I think we have to change our mentality. And I've heard many times producers will say, I don't want to pay that premium on top of everything else I already got into that animal. And I just go, it allows you to sleep at night. It allows you to stay in business long term. Those are the things that I think we need to be focused on, Megan.
And we'll continue to have this question. So have this conversation. So if you have questions, if you want to throw the book at Scott Brown and test his economic knowledge and economist brain about how we move forward to protect your bottom line, that's why we're here. Go to our website, go to brownfieldagnews.com. You can submit your questions. If you were watching us on Facebook Live, you can ask those as well. I can monitor that so we can do this all in real time. Being able to manage risk and protect operations to pass on to the next generation is part of the conversation that Scott and I have every week. So please ask. Please don't be afraid to ask. And if you don't have a question for Scott, or contact your local insurance agent and have that conversation with them and figure out and run the numbers to see if it works, right?
That's right. So don't let the details of the program make it sound like it's too difficult. Your crop insurance agent can sell you an LRP contract. They can tell you what your coverage is, what your premium is going to be. It's all very straightforward, relatively easy. So don't let all the new terms make you not want to go find somebody to sell you LRP.
I appreciate your time and you looking into this to be able to answer the question that I think I get probably the most right now when we're having conversations about managing risk for livestock producers, because it's been a different game than it has been for row crop producers for so long. And this is really an opportunity to do a lot of CYA moving forward, knowing where commodity or where contract prices are headed potentially, but also what could happen if demand stops, right?
Covering your assets is important.
All right. I will talk to you next week. When we look ahead, it's kind of a slow week for us. So what are we looking at in terms of reports?
Yeah, so we really only have one big report, retail prices, next week to talk about. Hopefully we'll see. I don't know which way to say who's better here, but maybe lower prices for consumers, move more product and help us as we get into 2023, Megan.
And maybe it'll just be a Scott Brown Q&A about LRP. This is your opportunity. You've got an entire week to test Scott Brown's brain next Friday.
I will start studying tonight.
All right. Always great to see you. Thank you so much for the information and the insight, and we'll talk to you next Friday.
Sounds good, Megan.
So our weekly livestock market update delivered to your email box every Saturday morning. Go to brownfieldagnews.com. You can also submit questions and comments. And for market rundowns every day, check out John Perkins Market Minute. Have a great weekend. I'm Megan Grebner from Brownfield.